I don't want to sound like a Debbie Downer, but policies that sound too good to be true are usually too good to be true. At first glance, the 10% cap on credit card interest rates sounds like a real good idea for everyday Americans. Lower interest rate, lower monthly payments, and more breathing room for all of us. But here's what most headlines miss. Housing affordability is not driven by one number. It is driven by access to credit, liquidity, and consumer behavior. And that's where this proposal could quietly ripple into the real estate market, especially in fast growing cities or states like San Antonio, Texas, where affordability and migration tend to be tightly linked. Banks are not pushing back because they're being greedy. They're pushing back because credit systems do not compress neatly without consequences, serious consequences. And those consequences matter if you are a family planning to move, a buyer watching the mortgage rates, a homeowner thinking about long term equity. What Trump proposed and why details matter. President Trump has called for a 1-year credit cap on credit card interest rates at 10% starting on January 20th. The goal is to ease cost of living pressure and restore affordability. But there's a major issue. No enforcement mechanism has been defined, no executive order, no legislation, no regulatory framework. Industry analysts, including Morningstar, agree Congress would likely need to act for such a cap to be enforceable. That uncertainty alone is enough to make financial markets and lenders react defensively. Why banks are sounding the alarms? According to the Electronic Payment Coalition, a 10% cap would severely restrict or eliminate access to 82 to 80% of card holders, especially those below 740. Why? Because credit card lending isn't priced on interest rate, it's priced on risk. Subprime, moderate income household, and small business owners would be the first affected. Not good. Banks argue would result in higher annual fees, fewer reward programs, reduced credit limits, closed account, which leads something critical for real estate. Reduced customer liquidity, the hidden link between credit cards and home buying. Most people assume mortgages exist in isolation. They do not. Credit cards influence bank debt to income ratios, emergency liquidity, down payment stability, buyer confidence. When access to revolving credit tightens, buyers pause even if mortgage rates fall. That is why lower rates don't always translate into lower priced homes. What the data shows right now. According to reports, average APRs hit 82% on general cards. Private label cards exceed 31%. Minimum payment only users are at the highest level since 2015. Banks argue that cap rate at 10% would make many card portfolios mathematically unprofitable. And when lending becomes unprofitable, lenders pull back. What happens when credit tightens? Historically, tighter consumer credit leads to slower consumer spending, reduced household mobility, delayed home purchase, increased rental demand. For San Antonio real estate, this matters deeply. San Antonio thrives because it remains affordable compared to Austin and Dallas. It attracts families relocating for lifestyle values. It benefits for stable employment sectors. But affordability is a system, not a headline. San Antonio real estate, why the city is different compared to the others. San Antonio is in a unique position during moments like this. Why? Lower medium home prices compared to other cities. Migration demands remain strong. Military, healthcare, and manufacturing stable employment. Buyers often value driven, not speculative. If credit tightens nationally, San Antonio becomes more attractive, not less, especially for families priced out of other Texas cities. The bank executives warning code. Executives from JP Mortgage, Citigroup, Bank of America, and Wells Fargo all agree on one thing. Affordability matters, but they argue blunt cap creates credit rotation, not relief. An executive warned that subprime buyers would be hit the hardest because those same buyers are often first-time homeowners, relocating families, workforce households. When those buyers lose access to flexible credit, housing demand shifts, not disappears. What that means for San Antonio buyers: if this cap moves forward or even threatens to, buyers would understand the system early, gain leverage. Smart buyers focus on stable budgeting, strategic timing, local market knowledge, long-term livability, not just interest rates. What this means for sellers: for sellers in San Antonio, demand may concentrate in affordable neighborhoods. Low-priced homes will outperform. Move-in ready homes gain premium appeal. Sellers who price with buyer psychology in mind will win. The misconception most people miss: lower interest rates do not equal cheaper homes. Credit caps do not equal affordability. Policy headlines do not equal local market reality. Real estate is local. Credit is emotional. Timing is strategic. If you or remember one thing, remember this: affordability is not about forcing prices down. It's about keeping families mobile, confident, and informed. And that's where San Antonio continues to shine. Why does this benefit San Antonio real estate? Long term. As the national markets fluctuate, San Antonio remains stable. Points of entry stay accessible. Long-term equity remains strong. Family-driven demand continues. This city benefits when buyers prioritize value over hype. This is not about politics. It is about planning. Families who understand how credit, policy, and local markets interact make better long-term decisions. And in San Antonio, those decisions will create opportunity. Do not forget to like, subscribe, and leave a comment. And if you're looking for a new home in San Antonio, visit this website right here.